Hello friends, today's lesson is on chargeability under section 56 of the Income Tax Act 1961. The incomes that are chargeable are defined under section 2 subsection 24, which is an inclusive definition. The various items of income that are covered for tax purposes under section 24 under section 2 subsection 24 are divided into 5 heads of income, as we already know. The 5 heads being salary, house property, business profession, the fourth one is capital gains, and the last one is other sources. The last one is obviously a residuary head. What does it mean? If an income is not covered under the first 4 heads, then it will be dropped down or covered by the other sources head. Now, the items that are covered under other sources head can be broadly categorized into 3 for the purpose of study. The section doesn't group them, but we group them into 3 so that we can focus them on and learn them. The first one is dividends on shares. The second one is interest on securities, and apart from these 2, we say the third one as a miscellaneous items that are covered under other sources. Let's take up dividends on shares first. Now, dividends received from a domestic company are exempted from tax under section 1034. Then there is section 2 subsection 22, which talks about deemed dividends. There are about 5 clauses in this section. The first 4 clauses A, B, C, D are exempted for the purpose of tax in India. The 5th clause, section 2 subsection 22 clause E, continues to be taxable. So please note that deemed dividends covered under section 2 subsection 22 E is still taxable in India. What does this clause E talk about? It is a very complicated clause. Putting it simply, it covers dividends received from a closely held company in the form of advances, and if such advances are given to the shareholders without any intention to take them back, they are regarded as dividends to the extent the company has accumulated reserves. Then there is a question of dividends from foreign companies. The dividends received from foreign companies are taxable in India. The point to be observed is, if such dividends are received net of tax, that is after TDS, then grossing up need not be done. At this juncture, I will bring attention of the students to this process called grossing up. There is a concept in income tax which says money earned is income and not just money received. So the taxes that are deducted from foreign dividends, let's take an example. Suppose Mr. Z has received a dividend of 45,000 from a foreign company, and 5,000 rupees was deducted as tax from the source, the company which issued the shares. Then only 45,000 is received by him in India, and according to the rule, the 45,000 itself is taxable in India without converting it back into the grossed income of 50,000. So foreign dividends are taxed without grossing up procedure. Now we come and focus on the second topic of interest on securities. Securities, in particular debentures, bonds, when people invest in them, they get interest. So interest is income in the hands of the SSC. Such income is taxable, and that is covered under interest on securities of other sources head, provided the securities are not held as stock in trade. That is, in the case of an SSC who is a trader in securities, to such a person interest on securities will be taxable as business income. To other people who are not dealers and traders, they will be taxed under the other sources with respect to the income received from the securities. To understand the securities properly, we have to learn 2 concepts. One is the issuing authority. The securities can be issued by government or commercial entities. Under government, central, state, local governments are all covered, and the commercial entities may be listed on the stock exchanges, so they are called as listed shares, or the commercial entities need not be listed on the stock exchange, so such securities are described as unlisted securities. Now, with respect to government securities, there is no TDS. Section 193 of the Income Tax Act imposes a duty on the payer of the interest to cut TDS from the amount paid. So we should observe that government securities are not subject to TDS, whereas commercial securities are subject to TDS of 10%. That is, out of every 100 rupees of interest payable, 10 rupees will be cut as TDS and the remaining 90 rupee will be paid to the investor. Then apart from this issuing authority, we should also focus on the types of securities. Broadly speaking, there are three types of securities. The exempted securities are those whose interest is exempted under section 1015 of the Income Tax Act. The government has notified certain securities which are exempted for tax purposes under this section 1015. So interest received by the investor will not be taxed. Then there are less tax and tax free type of securities. As the name itself suggests, less tax securities are those from which TDS will be cut. Now these two we will be understanding further with the help of examples. Let's take up less tax as the first one. So less tax securities, as the definition itself is giving us, the tax will be deducted. Less tax means less TDS, net of TDS. So the amount received after TDS is technically described as net income, and NI is the abbreviation we will use for this, and the amount which is earned by the investor before TDS is described as GI, the gross interest. Let's take some examples for further analysis. Consider example 1. This is a case where amount invested and the rate of interest is given. So whenever people invest money, they look for return. So amount of investment and the return rate of return is given in this example 1. So the amount invested is 50,000 in 12% debentures of P Limited. Now the income earned by the investor Mr. Z is rupees 50,000 into 12%, that is 6,000 rupees. So this 6,000 rupees will be paid by P Limited to Z after cutting 10% of TDS. So 10% deducted and the balance of 90%, that is 5,400, will be paid to the investor along with the TDS certificate worth rupees 600. So please observe the example here. This is a very simple example for less tax securities. The amount of TDS is deducted from the income earned by the investor. That is the point to be observed. Let us consider example number 2, and this is a situation where the interest received is given. So the interest received here is rupees 45,000 by Mr. Z from his investment in Q Limited. This 45,000 is obviously after TDS, because the company which paid the interest is obliged to make the TDS. So how much TDS was made? We just observed that it is 10% for commercial securities. So if 10% was deducted, it is obvious that 90% was received. So this 45,000 represents 90%. So in order to find the original amount, or that is also described as gross income, so GI is equal to NI divided by 90%, that is equal to 50,000. So the income earned by the investor is 50,000, and the 50,000 will have to be disclosed in the computation of the GTI, the gross total income. And the TDS that was made, rupees 5,000, can be claimed as a set off while paying the tax liability. At the time of tax liability payments, the TDS will be adjusted and the balance tax will be paid by the investor. Now the example 3 is a case of government securities, and here too the investment is given along with the rate. Suppose the investor invested 1 lakh rupees at 12% in the Mumbai municipal bonds. So the interest earned by investor is 1 lakh into 12%, 12,000. Since government securities are not subject to TDS, all 12,000 will be paid to the investor. So there is no difference between GI and NI, you have to observe. Now let's look at example 4. Here the SSC has received rupees 7,500 from investment in the bonds issued by Delhi Municipal Corporation. The issuer is a government entity, so there is no TDS, which means that the amount received itself is the amount earned, that is GI and NI are one and the same. So there is no need of grossing up. The 7,500 amount received itself is regarded as the gross amount to be included in the income of the SSC. So as you can see, examples 1, 2, 3 and 4 are various illustrations of less tax securities. The bottom line being tax deducted by the issuer from the income of the investor. Let's consider the next type of securities, that is tax free securities. As the name itself suggests, tax free securities are those from from which the TDS will not be deducted, but however the TDS will be paid on behalf of the SSC by the issuer to the government. Let us take example 5 and 6 to understand further. Example 5 is a case where the SSC has invested rupees 1 lakh in 12% bonds issued by a certain company R Limited, let us say. Now, the computation of tax free is in two stages. Stage 1 is to ascertain the income earned by the SSC, that is rupees 1 lakh into 12% comes to 12,000. So, the name tax free, as it is obvious, the issuer should not make any TDS from this amount of rupees 12,000. The entire amount of 12,000 is paid to the SSC, but on behalf of the SSC, the issuer, that is R Limited, will pay to the government tax which is to be worked out at 10% of the gross amount. So, the grossing up will be in the form of the formula which is given there, GI is equal to net income by 90%. So, you can observe that step 1 involved is calculation of the interest on the amount invested. The interest so calculated is to be regarded as NI because it is received by the SSC. The 12,000 rupees are received by the SSC, and on behalf of the SSC, the tax paid by issuer to the government, if it is included, the total amount will become the gross income. So, gross income is 100%, 90% which is received by the SSC is rupees 12,000. So, the proportionate calculation would be NI by 90%, that is 13,333 rupees 33 paise to the paisa if we calculate, and generally students are required to round off to the nearest rupee. So, 13,333 would be enough. So, the gross income is to be included in the income of the SSC is rupees 13,333. So, the observation that students should make here is that the tax free securities go in two stages or two steps. Let us contrast this example 5 with example 6 now. In example 6, the amount of interest credited to the bank account of the SSC is given directly. So, SSC has received 7,500 rupees from his investment in the form of securities issued by S Limited. So, in this example, as contrasted with example 5, the interest earned and received by the SSC is given. So, step 1 is already over, that is what the student should observe. So, step 1 being completed, they will go directly to step 2, and step 2 is calculation of GI, that is net income divided by 90%. So, 7,500 divided by 90% will give a gross income of 8,333. So, in summary, we should observe the less tax and tax free in contradistinction with each other. Less tax securities are those from which the TDS is made from the income of the investor, whereas in the case of tax free, the interest earned by the investor is handed over or paid to the SSC without making the TDS, and additional amount is paid on behalf of the SSC to the government by the issuer. But money received as well as money paid on behalf of the SSC both are regarded as income. So, the grossing up will be done in the case of tax free securities also. Fees received by directors are charged not under salary but under other sources. Let us remind ourselves that other sources is a residuary head. If any income is not covered under the first 4 heads, then it will be covered by the 5th head. Now, taking the example of this director's fees received by director is not covered as salary because there is no employer-employee relationship between the company and the director. So, the director's fees will be charged under other sources. Similarly, salaries received by MPs and MLAs are also chargeable under section 56 as other sources. Let us take other examples. Rent from letting of an open land. As we can recollect, rent from building along with land, it is taxable under the head of house property, whereas here it is an open land, it does not have any building. So, rent from open land will be taxable as other sources because it is not covered by house property. Another example which is of similar type is rent from subletting. If an SSC has taken premises and further let it out to some other entity, so the rent received by the SSC as in the process of subletting will be taxed under other sources because house property stipulates ownership of the premises. In this case, the SSC has taken the premises on rent, not being the owner, so it will be taxed as other sources. There are few more examples. Family pension. In the case of family pension being the amount received by the spouse of the deceased employee. The employee had a relationship with the employer, but the spouse of the employee does not have a relationship with the employer. Hence, family pension is taxed as other sources. Of course, there is a standard deduction allowed in the form of 1/3 of the pension received with a maximum limit of 15,000. Then there are several interest items such as interest on FDs, interest on RDs, and interest on savings banks. And the bank itself need not be a scheduled bank, it could be a private sector bank or a cooperative bank. Interest received from post office fixed deposits and post office recurring deposits, we are subject to a deduction of 3,500 in the case of an individual holder. Of course, interest received from savings bank in a post office is exempted from tax. Then there is interest from money lending, which is not done as a regular money lending business. Now, at this juncture, let us observe one common feature of chargeability of section 56. It says that any item which is not charged as business or profession will be charged as other sources. That is to say, taking this money lending as an example, if money lending is not conducted as a business activity, if it is done occasionally or intermittently, then the interest received by money lending, for example to a friend or relative, some such thing, will be taxed as other sources. And there is one more prominent item among this chargeability of section 56, which is in the form of letting out of machinery, plant and furniture. And again, the act says that if such letting out of machinery, plant and furniture is not done regularly as a business activity, then it will be taxed as other sources. Which means, if the letting out of machinery, plant and furniture is done as a regular activity, as a business activity, the chargeability will be under section 28 under the head of business and profession. Now, after the abolition of Gift Tax Act, the taxability of gifts has been shifted to Income Tax Act, and section 56 subsection 2 clause 7 talks about the gifts received by the individual and HUF during the current previous year. The taxability of gifts can be observed in 4 categories. Let us go through these categories. They are simple and easy to follow with some conditions. Category A, of course, the income tax law does not give this numbering or naming of ABC. It is for our convenience that we describe them as ABCD categories. So, category A covers cash gifts. So, gift of cash received during the year is category A. And if the assessee has received cash gifts on several occasions, then the aggregate of the gifts should be taken. And if the aggregate exceeds rupees 50,000 during the year, then the entire aggregate amount will be taxed. Like the gifts have been received at the time of a birthday or a wedding day, anniversary, such occasions, then the total gifts received, if they exceed 50,000, then the entire amount will be taxed. Please observe that it is not the extra amount. If an assessee has received gifts totaling 70,000 during the year on different occasions, then the entire 70,000 will be taxed and not the extra amount that is to be observed. Now, category B talks about immovable property. Immovable property could be in the form of land or land and building or a flat in such way. The immovable property may be received either totally free without consideration, or it may be received for less than adequate consideration. Let us take the first situation. If the immovable property is received by the assessee as gift without any consideration, then the stamp duty value, that is the registration value as per the local records, shall be observed, and the stamp duty value shall be taken as the gift value, and it will be taxed if the value exceeds 50,000. And you should the students must observe that each gift should be regarded separately. They should not be clubbed. Like example 1 or category A, which we were observing, the entire cash gifts are to be aggregated. So, out of categories A, B, C and D, please observe that category B is the only one which considers each gift of immovable property separately. So, if the value of the building is exceeding 50,000, then the entire amount will be taxable under the other sources. In same category B, there is a amendment which is made recently, which says that if the immovable property is received for consideration of less than the stamp duty value, it is not received absolutely free, it is received for some consideration but inadequate consideration. In such a case, the difference between the amount paid and the stamp duty value will be calculated, and if such difference exceeds rupees 50,000, then the entire amount of such difference will be taxable. For example, a flat worth 30 lakhs has been received, has been purchased for 25 lakhs. So the difference between the worth stamp duty value of 30 lakhs and the consideration paid is 25 lakhs, the difference being 5 lakhs, and this 5 lakhs exceeds the threshold amount of 50,000. So the entire difference of 5 lakhs will be taxable in the hands of the SSC as gift under section 56. Moving on to category C, it covers movable property received without consideration. So category B is covering immovable property, category C is covering movable property, and movable property including capital assets such as jewelry, works of art, paintings, sculptures. So if any SSC receives these items without consideration as gifts, the fair market value of such item on the date of gift will be considered, and if SSC has received several movable assets of this nature during the year, then the aggregate shall be taken, and if such aggregate exceeds 50,000, the entire amount will be taxable. So just like category A, here also aggregate shall be considered, and if the aggregate is exceeding 50,000, entire amount will be taxable, not the difference point to be observed. So to take an example, during the year if SSC has received a painting worth 20,000 and a sculpture worth 50,000, then the total works out to 70,000, which is exceeding 50,000, then the entire amount of 70,000 will be taxed. And finally, category D is gifts of movable property received for inadequate consideration. That is to say, SSC paid some amount but did not pay the full value or the fair market value. So here also the difference between the fair market value and the amount paid by the SSC will be calculated. If SSC has received several gifts of this nature, that is category D items, that is to say movable property for inadequate consideration, then the difference between the consideration paid and the fair market value of each such gift is calculated, and the total will be taken, and if such aggregate exceeds 50,000, such aggregate is entirely taxable. In conclusion, we should observe that the coverage of section 56 is a very wide one. It is not limited by any precise conditions. The only condition is that if any income is not chargeable under the first 4 heads, namely if it is not covered by salary, if it is not covered by house property, if it is not covered by business or profession head, and if it is also not covered by capital gains head, then it will drop down to the residuary head of other sources. That is the only test. It does not have any acid test or any conditions. The residuality is the only condition. So the individual items of coverage under the other sources are numerous. Some of the prominent ones we have covered in our lesson.